Good afternoon, everyone. Welcome to this market briefing webinar, aptly called Hydration Break. It is hot out there, but obviously we were trying to make a play on the World Cup. Thanks for joining us. It's a new time, new day. We've been told that the 12 o'clock time slot works better for most people during the lunch break. So thank you very much for adjusting your schedules. As always, I've got Vijesh with me, who is my dear colleague. We've been working together for 8 years. We look at the markets all day long, so you don't have to. And we hope that you enjoy this update. It certainly hasn't been boring. As ever, we'll look at these things very systematically. We'll look at the market drivers, we'll look at performance, and we'll wager an outlook, and we'll leave plenty of time for Q&A. If you notice that little text box at the bottom of your screen, as you have thoughts during the webinar, please put those into the box, and then Hannah will collate those at the end of the webinar, and we'll try to answer as many as possible. So without further ado, market drivers are always the same, as you know. For those of you who've been avid followers of these webinars, we look at inflation, we look at growth, we look at earnings, and we look at macroeconomic events. So in that regard, it's fairly consistent in terms of how we want to look at these things. Geopolitical risks were at the forefront, as you might recall from the last webinar. That's all we talked about. We did the last webinar at the beginning of April, so we were about a month into the war in Iran. So clearly there were quite a few effects, some of which have now been negated. Others have sprung up again today. But the one thing that the markets are obviously focusing on more than anything else is the flow of oil through the Straits of Hormuz. And you can see this massive drop off at the end of February when the missiles started raining upon Iran. They then closed the Strait of Hormuz and nothing was going through there anymore. And then since the peace agreement or negotiation time has started, we have now seen an uptick in oil passing through the Strait of Hormuz, and as you will see, the oil price has adjusted. The markets didn't seem to care for a long time. We'll get into that as well in a minute, but all is good on that front. The macroeconomic risks, Vijesh, it was all about trade policy not too long ago and tariffs and things like this. Why is this now? There's still talk about this. Trump still seems to be threatening people with tariffs. I think he did it today. I think he threatened that Spain wouldn't have any more US business, but it seems to be declining. What are your thoughts on that?
It's a good question. I think one key thing was, of course, the Supreme Court ruling, which is maybe a little water on the amount of power he really has to force this stuff through. So that's one thing, and I think the second is, of course, perhaps he's busy with other things at the moment, given the conflict in the Middle East. You can only fight so many battles at one time.
So, obviously, all of this has had a very positive view on inflation. This is a very busy chart. Can you maybe elaborate what's going on here?
Sure. So so here we're looking at the inflation expectations in the US, and what we can see is first there's a big spike up in around April 2025. That was on Liberation Day and the tariffs. It came markedly down as it didn't really seem that there were any inflation effects. And the second spike is around March, April 2026, which is, of course, the effects of the conflict in the Middle East, largely driven, again, by high oil prices, high inputs, makes things more expensive, and that can pass on to the consumer, whether at the petrol pump or in everyday items.
I mean, these are big moves. Historically, we didn't really see inflation expectations sort of move up and down by a couple of percent in a month. Surprisingly, this hasn't had really that big an effect on the U.S. growth outlook. The U.S. economy, is very resilient. It's just incredible how resilient, how strong the U.S. economy is. You can throw a lot of stuff at them. So even with all these spikes up and down, all this uncertainty, all these supply chain issues, we're still seemingly projecting around 2.5% annualized growth for the US on the year. Last quarter it was fairly low as far as the US is concerned. We even had a month where it was almost near zero. That's now picked up again, and obviously for Q3 we're expecting a big increase in growth, probably as a result of the effects of the war declining. what this means in terms of the markets is it's all about rate cuts. So as you might recall, up until the war started, the inflation was mainly under control. As a matter of fact, inflation was under control a lot until this whole tariff stuff started. It then picked up, but then it declined. At one point we were pricing in, even as recently as April, we were still pricing in half a cut. Of course, the rate in the US right now is at 3.75%. And now the markets are implying, based upon where the forwards are trading, that by the end of the year, we're still going to, or at least this was in April, that was the case, that we're going to be at a rate of 3.5. Currently, we're at 3.75. Now, this quarter, we're pricing in a rate and a quarter hike, and that would take us to 4% by the end of the year. Now, in Europe, this looks very different. We'll have a look at the UK in a second, but as you know, the US is a net exporter of oil, so they're obviously affected by what's happening in the Strait of Hormuz, but not so much the Europeans. In Europe, the forwards were implying 4 rate cuts at one point. I think even in the UK, is that right? Vijay, we had 4 rate cuts we were pricing in for the UK.
Yes, yeah, very briefly, 4 rate hikes. Yeah.
But none of us really believed they could do this, right? Because it would absolutely destroy the economy. So maybe for those listeners who aren't familiar with these implied forward rates, how do you explain that? The markets are implying one thing, but the investors weren't really expecting these 4 rate cuts.
Yeah, I mean, it's a weird one because it's a weird one because sometimes it almost defies belief, as you put, Christian. But I mean, the thing is that a lot of fixed income traders are driven by positioning, maybe taking some risk off. There are other drivers than just necessarily what we expect to see in inflation and things like that. So that's one thing. And yeah, positioning is key here.
Yeah, I guess that makes a market, right? There are potentially not arbitrage opportunities, but trading opportunities if you do think the market's got it wrong. And for those traders that bet against these rate hikes, they made a lot of money, as we will see. Here's the UK. So this looks very, very different, and it's slightly different chart that we've got here. So we have a base case and a pessimistic case and a downside case. We also have a change in government coming up in the UK. What are your thoughts on UK inflation, Vijesh?
So I mean, the key thing here is, what we're sort of expecting as the base case is around 4%. And the reason why that's so important is I believe after 4% is really where I think studies have shown central bankers need to get worried and maybe consider hiking rates. However, it's not the case. We're expecting 4%, obviously, with oil prices having come off. Fortunately, the UK economy also has some headwinds as well, which will also likely subdue inflation, and that is what we've been seeing. So that's sort of how to explain it. I mean, you have these different scenarios here. Obviously, the scary one is the downside risk, which, of course, would see us peak at around 7% inflation. Not quite as bad as what we saw in 2022, 2023. But still, that would be a scenario where maybe we would be seeing, the 4 rate hikes that the market was previously pricing in.
Right. Well, it's good to have that in the back of your mind. Growth in the UK is pretty anemic, has been for quite a while, particularly since Brexit, if I dare say the words. Obviously, we have a new government coming in, probably a new chancellor. If the betting markets are to be believed, there's going to be new policy. So this can change in a dime. So stay tuned for next quarter to see where we are. But right now, the markets are sort of expecting, and these, by the way, are the sources. It's not us projecting these things. So these are very serious people with PhDs and things like this. So we're looking at about 1% growth, or roughly half what the US is expecting. Rate cuts look very different. So unfortunately, because we're looking at this quarter to quarter, we can't now show you the screen when it was implying 4 rate hikes, but trust me, it was, a couple of months ago. So, things look a lot better now. And this is now the difference to the US. In the US in April, we're still pricing a cut. And then in July, we're pricing a hike. And this is what I mean. In April, the Europeans really took this war in Iran on the chin, because they're net importers of oil. That drives inflation, that drives these interest rates expectations. So actually now, things are a lot better, as it turns out. And for the moment, maybe, as long as they don't do anything silly, we could be looking at a fairly benign outlook for interest rates. We hope that's the case, but let's see. And finally, U.S. earnings, big driver, and as always, we're always holding these webinars just before earnings season starts. So in the US, the earnings season starts next week. Again, we're looking at US earnings mainly because that's still a large part of the market. The US economy still drives the rest of the world, even though we've had some big shifts this year and also last year in terms of people taking money out of the US and into the rest of the world. But for all intents and purposes, these earnings expectations are still off the chart. Vijesh, these energy sector earnings expectations, is still that thing the case, or is still assuming $120 oil? Is that maybe coming down now a little bit?
Perhaps a little bit, but I think these numbers do still include or do account for the fact that the oil price has, of course, decreased as well.
Yeah. And obviously, technology is still driving things. We'll have a closer look at that in a second. So there you go. One more earnings chart. This is actually quite interesting one. Remember, Wall Street always plays this game with earnings, because the analysts, they have expectations in terms of what the earnings are going to be. And then the companies, when they actually report earnings, they try to beat that. Now, obviously, everybody's caught on to this game. So also the analysts revise their earnings upwards or downwards, depending on what the companies communicate with them. But again, this is a very interesting chart, Vijesh. Can you just run the audience through what this all means here?
Sure. So this chart is showing the rate at which stocks in each of these indices, their earnings expectations are being either raised or revised lower. And in this case, as has been likely the trend for a while now, it's been tech in the US that has been leading the way, and we can see right at the top end of that, I think a ratio of 2.5 there. And on the flip side, you have the stock 600, which is the broad European index. It gets exposure to the UK, Switzerland, Germany, France, etc., and those are actually being revised lower. So a very interesting, mix here.
So despite all this talk about the bubble and the AI spending, the US tech is still delivering. And Europe, as much as they're trying, they're still struggling. So much for the rotation. Interesting that a week ago, this was at a much different level. What happened in the last week? Is it just because we're getting closer to earnings season, so people are trying to get their house in order?
Yeah, I think partially that, and also I think this chart may be a couple of weeks old as well. So I think this is also when a lot of these are also being just risen as well, and perhaps on optimism.
Okay. Okay. All right. Well, listen, I mean, this brings us now to performance. We try to be up to date, but this world changes so quickly. And you'll see that, even though we did these charts yesterday, a lot's happened overnight, particularly in the oil markets. So we'll get into that in a second. But as far as performance is concerned, and we'll start with the S&P, obviously, as the main benchmark. It's cool. It's nice. No problems. We obviously had a few little wobbles. This was Liberation Day. This was this Iran war. But broadly, we've been in this uptrend now since the lows in 2022. As you might recall, we had COVID. Things went pear-shaped, which you can't see right now. In 2020, the S&P was down at its peak around 35%. Then you had all the stimulus coming in, which was great, but that caused inflation, which was not so great. And then 2022 was a bit of a disastrous year. I think the S&P was down 20%. And then, we started getting fantasies of rate cuts again. And that's really what's been driving these markets now for the better part of 4 years. Obviously, there are other factors, as we've just discussed. But this is a nice channel, and we seem to be on top of it. Not so much in Europe, but we seem to be getting there now, Vijesh. What do you think of Europe?
I mean, with Europe, it's always the same story, of course, as we both know so well now.
Right? Yeah.
We all get very excited about it, particularly as an alternative in terms of where you can invest to the US. However, there are just two very different economies, and also two very different types of companies that make up these indices. In Europe, you don't really have as much tech. The best we have really is ASML, which produces the machines to produce semiconductor chips, which is great. But aside from that, I mean, it is largely, staples, some software companies, energy, pharmaceuticals, and things like that. So not necessarily sectors where we're seeing the spectacular earnings growth and kind of global domination like we see in the US. Having said that, obviously, given last year, there has been some excitement around Europe as an alternative, and also in recent weeks, just given how much higher the US stocks have gone up since the March lows. So we are seeing Europe making a bit of a comeback, but again, the sort of upside is capped purely because of a weaker economy, and the sectors are not growing quite as fast.
So highly correlates the war. If you compare this, the US chart, since we hit that low in the market, it's just been on a tear, and it priced in these negotiations very quickly. Europe took its time. It's just only been recently now, since they've actually announced that there'd be a negotiation for peace. That's when Europe's now rallied and sort of made back that gap. The UK is even more pronounced. Looks a bit different. The UK is not part of Europe anymore, so it obviously has a different chart, and we like to look at the UK obviously because we have a UK-centric audience. As you will know, if you follow these webinars for a while, the UK has been a bit of a basket case over the last 15 years. The UK has underperformed the S&P by around 250%. Yes, that's not an error. It's 250%, just because the UK is very energy heavy. That ironically helped it at the beginning of the war. So when all the other indices were selling off, the UK was actually doing quite well. And since then, it's done very little. Any views on the UK? I mean, again, it seems to have got there now finally, but we still haven't made back this peak from pre-war. In Europe we have, in the US we have, but we haven't done so in the UK. Is this now business as usual, or can we expect something come to life here? Maybe it also has to do with the new Labour government. I don't know. What are your thoughts, Vijesh?
I mean, I think it's largely still business as usual. So the FTSE 100, which we're showing here, is a pretty global index. So most of the revenues are actually derived internationally and not in the UK. Having said that, there is always the UK sort of valuation discount you get just given the lower growth here, and again, headwinds to the economy, geopolitical uncertainty as well. So personally, I think it's business as usual. However, perhaps if we get some certainty around what the government is going to be doing in the next few months, maybe we will see a bit of a pickup here.
Let's see. We await. And here's emerging markets. That's just been again, this is the COVID spike, and then we had this large downtrend, mainly driven by China, which is a big part of this index. As you know, the Chinese economy, they got hit by COVID a little bit differently. They were closed at first, which accounted for this little spike here. It went up when everything else went down, but then once they opened, they got really hit, and they never really recovered until last year. Ironically, again, sort of the Liberation Day was sort of the kickoff, and since then we're up almost 72%. Now there is a lot going on here because emerging markets is obviously a huge market. Not just China. You've got India in there. You've got Taiwan. I've given it away now, but a lot of this growth, Vijesh, is driven by which countries?
So Taiwan and, interestingly, South Korea. It might not necessarily seem like an emerging market, but it is in the index. And that's purely because of tech. So actually what we're not seeing in Europe, of course, is high semiconductor exposure. But interestingly, in the emerging markets, we do have those sorts of companies. So Taiwan Semiconductor produces like most of the semiconductors globally. And also, due to the spending from the US hyperscalers, the likes of Google, Microsoft, etc., into AI, there's a lot of spending on memory. And unfortunately, it's quite a finite resource at the moment. So at the moment, these companies on higher memory prices are just getting an absolute tailwind and a massive surge in their revenues. So what's interesting is, despite maybe looking at some of these companies that are up 10 times in the last year or so, what's shocking is that the PE on a forward-looking basis is around 6 or 7, and that's purely because of this. I mean, short-term earnings spike, but still a huge earnings spike nonetheless.
Wow, that's incredible. I mean, for those of you who are listening, if you want to look at the Kospi, I say no more. I think it's up 200% in 12 months. Just absolutely phenomenal. What's not so phenomenal, it has been the US dollar. Now, this is the DXY index. So this is just the US dollars against the major pairs, mainly the euro, which accounts for half the index, but it also has in the yen, the pound, the Noki, etc. So it's trying to give us an understanding of what the dollar has done against the world, against the rest of the world. And I recall in January, we thought it was all over. This was part of this rotation trade. Everybody was calling also for the end of the reserve currency, and everybody was telling me, the dollar is dead. 6 months later, that doesn't seem to be the case. Obviously, we've been helped by the war, because in times of distress, people still buy the safe haven currency, which is the US dollar. But it's surprising. I am surprised at this. I kind of bought into this narrative that when there's no stress in the world, people tend to get out of the dollar, because like I said, you buy it for a safe haven. So if there's nothing going on, you buy something else. But this spike occurred. The rebound already occurred before the war, and now, of course, with the war, it continues to go up. But interestingly, and this is what's surprising, it hasn't come off now that this war premium has to have gone out of the markets. Vijesh, you and I have fought many battles with the FX, particularly cable. So many scars on our back. But I'm going to ask anyway. What's your view on the dollar, Vijesh? Do we still continue this uptrend? What factors into this now? If it's not a war, what's going on?
Yeah, I mean, the key drivers. So, I mean, I guess there are three. The first, of course, which you've mentioned, Christian, is sort of the war premium in times of distress. We flock to the dollar. It is the reserve currency. The second is really that it's a relative game. So, what do you compare the dollar against? And the major players here are the yen, the euro, and the pound, all of which have very similar headwinds, which again weighs on their currencies as well. So that's one thing in favor of the dollar. And the third is, during this sort of whole sell the dollar, sell the America trade, a lot of that was driven by fears over the Fed's independence. The previous chair, Powell, was on his way out. Trump seemingly could just pick whoever he wanted, and we were very worried that it could be someone that could be convinced maybe to cut rates when maybe it wasn't so wise, which of course in the long term isn't a great thing. We don't want a manipulated currency as the reserve currency. However, Wash has so far seemingly proved pretty strong, and has given pushback on that whole narrative. So the dollar has recovered on that.
Interesting. I kind of like this 100 level. It's neither here nor there. As long as it's, the thing about currencies is I just don't like volatility, because ultimately, you're investing not because of the currency, you're investing because of underlying growth, etc. So the currency can really mess you up, particularly if you're on the wrong side of it. So I just like to see a steady currency. But you don't always get what you want. Speaking of steady, this is the 10-year yield in the US. Remember, we look to the US for clues about the global markets. The 10-year is an interesting instrument because it kind of is a very sensitive instrument to gauge fear in the market. It moves. It's a beast. For a 1% move in interest rates, the 10-year moves by 10%, the underlying bond. So particularly, this is what you saw here, where interest rates went from 1 to 4. The underlying bond lost, close to 40%. But since then, for the last 4 years, despite of everything the market's thrown at this, it's been relatively stable, just around 4.5, which is neither here nor there. I'm not really worried about that. I am worried about long-term yields, though, in the UK. So, if you think the 10-year is sensitive, the 30-year is really sensitive. So here, for 1% move in the underlying interest rates, the bond moves 30%. So, if you were one of the unlucky people who bought, a 30-year gilt in 2021, locking in 1% for 30 years, you're now down around 78%. Clearly, you can hold this bond for another 25 years and you'll make that 1% yield. But in the meantime, you're nursing very heavy losses. The other thing that it's painful, obviously, but the other thing that is interesting is that these long-term rates just haven't come down either. Short-term rates you can probably manipulate. Long-term rates are more difficult. So this is also a testament to the fact that the gilt markets are pretty worried about the UK state of affairs right now. Oil. So this is where we try to be very timely. I swear I did this yesterday, and the oil price was nice and low. This is Brent, by the way, which is the one that is the one that drives mainly through the Strait of Hormuz. And the war was done. We're back to these pre-war levels. But as I look at my screens now, we're up about 5% because Trump has now said that negotiations are over. So that's how quickly it can go. But certainly interesting that we're no longer up here. This is very painful. That's what caused these rate hike expectations. And so, we've come a long way. Where it goes, nobody knows. Vijay, the latest outbursts from Trump have been taken back a bit, right? You said that they're still talking.
Yeah. So I mean, Trump was asked in a conference or in a Q&A, is the ceasefire over? He said yes, but negotiations are still continuing, even though he, of course, doesn't trust Iran. So whether this is a negotiating tactic or it is something that he intends to follow through, we don't know. Obviously, there's a lot of uncertainty, and this has been the case for a few months now. So unfortunately, only time will tell. But we have been here before, and so far, oil's still well below $100 a barrel. This isn't enough to hurt people's, I guess, income yet. But yeah, something to look out for sure.
Something to look out for sure. Precious metals, so something to look out for here as well. You might recall that at one point, gold was up to 5,600, and the big winner in the precious metal was actually silver, which is the line in blue here. I never understood why people bought silver, because it's not what central banks buy. It's not really a safe haven. It's mainly industrial metal. But hey, the meme traders got a hold of this, and it was just on a tear. Not every client, but we had a few clients calling us saying, why don't you buy silver, Chris? Well, because reality bites. So silver's now down 50%. Gold's down 25%, and reality bites. What's the fair level in these things? I don't know. I'm not a gold bug, and I never understood silver. I just want to point out that what comes up can also come down. Speaking of which, we are in a crypto winter. So this is Bitcoin. We had a lot of discussions about cryptocurrencies over the years. It's all about these cycles, allegedly. But as you can tell, we're now back at the level that we were at in 2021. We had all this excitement when the Fed allowed investors to invest in these ETFs. That's what drove it up, institutional demand. And since then, it's just been an absolute disaster. We're down 50%. Again, where it goes, nobody knows. Is there still an investment case for cryptocurrencies? Who knows? Blockchain seems to be still alive, and tokenization still seems to be part of the AI project. So I don't think it's going to go to zero, particularly Bitcoin as sort of a decentralized token as a fight against deflation. Still has a lot of fans. The others, who knows? But we're kind of in the middle of nowhere right now. And like I said, the people that are in the know that we speak to, they're calling this the crypto winter. So much for performance. We're right on track. So we've looked at the market drivers. We got a very good idea of where growth is, inflation is, where earnings are. We've looked at the charts. We've looked at trends. It's all good. So where are we going to go from here? So, we don't have a crystal ball, obviously, but we do have things that we can look at that give us indications of where things may go. One of them is the US labor market. So this is interesting, and this is what a lot of people who aren't in the markets fail to understand. But here, bad news is good news. So the US labor market has slowed. Vijay, we had some big change in non-farm payrolls, right?
Yeah, they came out just last week. Still increasing in number, but some previous figures were revised down. But the headline is still growing.
So what, again, for those members in the audience who don't not know what non-farm payrolls are, so these are the jobs that the US economy added per month. And so you can see that US economy is still growing. We're still adding, but we're not adding as much as we used to. And the reason that that's good news is because when the labor markets are really buzzing, that means that inflation expectations go up, and that means interest rate hikes are being priced in. So as capitalists, pity the people who are obviously losing their jobs, but we kind of want this to be, neither here nor there. We want the economy to grow, but not too much, because we don't want it to overheat, and that means that the Fed will have to raise rate. Not just the Fed, but this is the same in Europe as well. Speaking of the labor markets, this is absolutely fascinating. Vijesh, run us through this, because we've had so many discussions about this.
Sure. So this is a chart showing the results of a study that was conducted, which is essentially looking at the impact of AI on jobs. And what these people found was that, interestingly, companies that had a greater adoption in AI, so more spending, more use by the average employee, actually hired more than firms that either didn't incorporate AI or didn't to a great degree, which is an interesting finding and maybe somewhat contradicts some thought. Obviously, there have been other studies that have shown something maybe in slightly different direction, but I think the key thing is here, it's not quite as simple as AI is going to take our jobs. There's also higher productivity increases that also mean you can hire more people to expand your business. So, I mean, there are also benefits to AI as well on the labor market.
It's fascinating because we had so many discussions, prominently with one client who we love dearly, and he was convinced that AI is going to take all our jobs, it's going to destroy the economy and sell everything, run for the hills. And there you go. This is why the future is so unpredictable. And this is what makes this business so fascinating. You just never know, whether this makes sense. I don't know whether it's sustainable. I also don't know. But just because AI is out there doesn't mean that all the humans are going to disappear. Could be in a few years from now, once they stick the AIs in the robots, who knows? But for now, this really flies in the face of a lot of expert expectations, and that's what makes it so interesting. Switching gears now, another discussion that we've had frequently with clients is this concentration, in the S&P 500. So, as you know, we have these mega caps that are growing like leaps and bounds. Nvidia is now, is it 5 trillion, 4 trillion? I've lost count. Apple, Microsoft, the titans of the world. And because their weight, because their size, they also have a big weight in the index. And it's troubling because traditionally, and we'll look at this in a second, when there's a high concentration of just a few companies, it tends to mean that the markets have reached the top. But there is a silver lining, Vijesh, right?
Yes, there is. Yes, these companies are ever concentrating in the index, but earnings have soared and actually pretty much in line with their market cap. So yes, these companies have grown a lot, but the earnings have justified much of that growth.
Interesting. Now, here's the chart I was talking about. So, history, that's why I say past performance is not indicative of future performance. I love that. We have to put that into all of our marketing documents. But this traditionally is when we've seen in the past, in these previous bubbles, when the Nifty 50, that was the advent of Procter and Gamble and the likes. And then we had tech and telecom, AT&T, the railroads. We've been here before, and whenever we've seen these large concentrations of the top companies, it has sort of preceded a bubble. So we seem to be here again now, but the difference is, of course, the earnings. Remember, back when Amazon and Google, as it was called, when they were being really bought up, they didn't have any earnings. They were going to make it up by volume. That, of course, was a lot of nonsense. We had this big correction, but there you go. We're here again, but like Vijesh just said, we do have the earnings to justify that. Speaking of valuations, Vijesh, this is also an interesting chart. Again, it speaks to the bubble that we're currently in.
Yeah, so this shows the price to sales and the proportion sort of in each category of degree of those price to sales. So price to sales is price to revenue. So X, what the price of a stock is, X the amount of revenue they make. So 10 times is very expensive. Sort of means to break even, you're looking at no margins or full margins, a complete profit given to the shareholder to make your money back over 10 years. 50% of the S&P have a price of sales of around or above 10 times. Having said that, again, largely driven by tech, where traditionally, expensive price of sales may have been around 2-3 times. These days, it probably is around 10, 11, 12 times, just because margins are so much higher in tech than they are maybe if you're just producing basic goods.
And here again is another way of looking at this. The earnings have kept pace. So it's not about PE; it's about the PE to the growth. And so far, these forward earnings make these companies look cheap. And just for your information, Nvidia is now on a forward PE basis is cheaper than a lot of the European industrials. Just for information. Maybe it's all about the free money, Vijesh. Maybe that's what we're going up. Despite the earnings, besides the tech, maybe it's just as simple as. What does this mean?
So this means that there's more money supply going around the US economy, which is a big factor to growth. Obviously, more money means more money going around, means more money in people's pockets, more money for banks to lend, and then more money for companies to hire, et cetera, et cetera. It's a circular economy. And what we've seen in the last few months or few years even now is money supply after a blip in 2022 has started to grow again, which is a nice little tailwind to the economy.
Which brings us to positioning, which is the other way of looking at it, and this is a bit of a contra-indicator. Again, the more people are leaning one way, the more likely it is to reverse. So this shows us the positioning in futures, in the futures markets, and as you can tell right now, people are long the S&P. They're long the Nasdaq. They're still long gold. They're still hanging on oil. I think people have now left the market. They're leaving it up to the Trump administration to trade, and then also the bonds. People are pretty negative on bonds. That has to do with the basis trade. But just for all intents and purposes, people haven't reversed their positions yet. We're still bullish. We're long growth. And short fixed income. Cash levels, another contra-indicator. So traditionally, this is a survey of the fund managers, and when fund managers go into cash, they become bearish. And what we're measuring here is when there are extremes. So when there's a crash or when there's distress in the markets, the fund managers go into cash, and that usually then means that at some point they have to buy back in. So it's a bit of a contra-indicator when you see these extreme readings. Obviously, it works the other way around as well. So at the moment, the cash levels are quite low, which is testament to this. People are long, so people have deployed a lot of their cash. We've been lower, so it's not something that will hit the panic buttons, but it's interesting. Positioning is favorable, cash levels aren't. As contra-indicators, you can draw your own conclusions, which brings us to the midterms. Big event in the US, obviously, 2 years after the presidential elections. So these are the betting odds now of whether or not the Democrats can take back the House or the Senate. Any thoughts on this, Vijesh?
I mean, it's hard to say. We haven't really seen much campaigning yet. But of course, if the Democrats,
it's coming, right? Yeah,
it's coming. Yeah. Of course, Trump's maybe popularity did lower in the conflict with higher oil prices, etc. So yeah, maybe the Democrats can take back the House. We've got a 40% chance of that at the moment, and maybe even do the sweep, which of course would rein in the Republicans' power. But that's good or bad, we'll leave that to the audience. But yeah, it is probably a bit too early to say, but there are definitely signs that the Democrats can at least take back the House.
Yeah. So the midterms are in November, and you will see increasingly now US politics shifting gears towards this. So we're in July now. We've got earnings season now in July. Then August, everybody goes on holidays. But I promise you, as of September, this is all we're going to talk about, because this is obviously all about the balance of power. And as we've said, without becoming political, at the moment, Trump is seemingly being able to do whatever he wants, including rescinding a red card. I had to get that in. I apologize. But the hope is that we have a balance of power, so that there is a just a check and balances. But I say no more. Sentiment is neutral right now, which is interesting. Again, a contraindicator. When everybody's afraid, markets tend to go up. When everybody's bullish, markets tend to go up. So right now, at the moment, we're exactly neutral, which kind of means we're neither here nor there, which kind of what we've seen so far. It's very difficult to lean yourself too far to the window. But luckily, we have the Wall Street pundits who are telling us where things are going to go. So this is a nice snapshot of the main investment banks and houses that do research. And these are their year-end targets for the S&P. You can see to the right here, the rationale. But, it's very difficult to find pundits who aren't bullish, because obviously brokerages make money when people buy things, not when they sell things. So in that regard, this is to be taken with a grain of salt. But it's nice to see that, on the whole, we're kind of expecting a little bit more upside in the S&P. Speaking of which, as you know, we always have a poll. That means we ask the audience where the S&P is going to go from now until next quarter. A bit of fun. A bit of competition. And so here we now have our poll. So, we asked you last time, will the S&P go up or down last quarter? This is in April, in the middle of the war. And 77% of us thought it would go up, and we were right. Happy days, actually quite up large, almost 15%. Who would have thunk? We also asked you whether oil would go up and down. And remember, that's all we talked about is oil. Not so much anymore, but in April, all we did was look at the oil price really to get clues where things were going to go. So we also asked the audience whether oil was going to go up or down. 81% of us thought it would go down, and it did go down. Very, very smart audience, obviously, driving from this very informative webinar. So again, we would now like to ask the members of the audience whether or not you think the S&P will go up or down. And if you could please now click on your screen to see what we want to do. I always think we should have elevator music to sort of bridge the time here. Hannah, you tell me when it's sort of most people have voted.
Yep.
Good. Okay. Excellent. I used to get insights into where things are, but my screen's changed. I don't know where people have pulled it. I think it's going to go up, but you got to be bullish. The other thing we wanted to ask you is, whether this crypto winter is going to sustain itself. So can you also please let me know whether Bitcoin's going to up or down? So as I'm running Bitcoin right now is around 62,000. So do you think next quarter we've left the winter behind us, even though it's in front of us, no pun intended, or whether it's going to go down into a deeper sleep? I see a green light. And then next question, we have to make this about the World Cup. And for those of you who saw last night's game, very exciting. It has been a very exciting World Cup. So also, if you could tell us who's going to be the winner. We're in the quarters now. There are 8 teams left, but we can't give you 8 choices. So we're going to give you the 4 main choices, which is France, Spain, Argentina, and England, which have done incredibly well with the German coach. Yay. Or is it going to be someone else? If you could also please let us know what you think. Smart money, I guess, is on France, but of course,
from the results, it looks like England are marginally ahead.
Excellent. You gotta love England. Come on. 1966. It's been too long. And King Kane and Bellingham are excellent. Let's hope so. Next game on Saturday, by the way. Before we get to the questions, just a quick reminder that we love to stay in touch with you. So we produce these weekly insights, which come out every Monday. We pick up the big story from the week before with some cynical words around that. We have a monthly newsletter and we have these quarterly webinars. So I hope you stay in touch with us. And you can do that by going to our website or by sending Hannah a short email. How are we doing on time? Perfect. We've got 50 minutes left for questions. Hannah, what do you got?
Yep, okay. So our first question is, any thoughts on the UK and the effects of the upcoming change in Labour leadership?
Now, the great thing about doing these webinars with Vijesh is that for the hard questions, I can just defer. So, Vijesh, what do you think?
Yeah, I mean, it's a great question to start with. look, I mean, there's still a lot of uncertainty about the policy that the incoming PM and Chancellor, whoever that will be, will enact. Obviously, we can only hope that it's sensible. So far, fixed income markets don't seem too worried, which is a positive, perhaps even to our surprise. But I mean, there are certainly risks, and again, all we can hope is that we don't have a trust moment or anything like that. It does seem that obviously it would likely be Burnham coming in as PM. He has said they will stick to the current manifesto. Obviously, he's promised more spending, which will either mean, or at least more spending in some areas, which will either mean cutting spending in other areas, which has proven difficult, unfortunately, and or unfortunately raising tax. As we said, we just hope it's something sensible.
Yeah, I have nothing to add to this really, and the reason that we have nothing to add is because he's kept his cards very close to his chest. There's all these stories that they're leaking. If you read the Telegraph or the Daily Mail, you get one world. If you read the Independent or the Guardian, you get another one. But no one knows. Maybe he hasn't made up his mind yet either. But what I do sense is that one way or another, taxes are going to go up because he has this black hole. The growth isn't there. And obviously there's a lot of pressure to increase defense spending. So let's see. But it's difficult to get optimistic about this. The one thing about Starmer was that they'd already done their damage. They'd already raised taxes. So you would have hoped that they now we're kind of at the end of that. Whether or not that's likely or not is another thing. But now you have a fresh face coming in, and it sort of gives them a fresh bout of raising taxes. I just hope they don't raise capital gains to income tax level, because that would be a disaster for the markets. Moving swiftly on before I lose any more sleep or say something that I will regret. Hannah, next question, please.
Okay, what is your view on SpaceX?
This is another question that I'd love to defer to you, Vijesh, but I've got a lot of thoughts on this. So here are the facts. SpaceX lost $5 billion last year and has revenues of $15 billion. And it's now valued, even after the sell-off, I think it's still valued at $1.175 trillion. So if you do a quick math, if you thought 10 times sales was expensive, this is just so far off the chart, it's not even funny. Now, part of the reason why SpaceX has been driven higher is because Elon came out and said that he's going to produce, 5 trillion of revenues by 2030? Yeah, so we go from 15 billion to 5 trillion in 3.5 years. Never been done before, but of course, we've never had a rocket man. And Wall Street has also bought in. So a lot of the Wall Street analysts came out very positive, because the one thing that SpaceX is now going to do is they're going to go on an acquisition spree. They've already bought a company, because they have their shares now as currencies. That's why they went public, so they can just give people shares and just keep buying other companies. And that, of course, is good for the merchant acquisitions departments at the banks. And if you have a sell rating on SpaceX, Elon isn't going to give you business. So it all seems a bit manipulated. It all seems a bit crazy. Is this a sign that the apocalypse is upon us? Maybe, but we're not even done yet, because we also have Anthropic coming out and OpenAI. So these are two more heavyweights that are going to go public in the short term. It is hard to imagine that a company can grow that fast. But I suppose if anyone can do it, then it's Rocket Man. Would I put a lot of money into SpaceX at this stage? Probably not. But then again, I wasn't also a buyer of Tesla, and have given up shorting that stock in the last 2 years, and that's still going up. And by the way, he's also promising that Tesla will have 15 trillion of earnings at some point, all driven by AI. If you're as sick of this as I am, then join the club. For others, it's very exciting, because you have AI infrastructure in space. You have people going to the moon and to Mars, and of course you have the one business that is quite successful, which is Starlink, which not only can give you internet if you're in the country and you have no broadband fibers, but also, of course, it's proved very beneficial in the war. They have a lot of satellites up there. Vijesh, what are your thoughts on SpaceX? And we do talk about this a lot, so hopefully you won't repeat what I said, but do you have any other pearls of wisdom?
As you said, valuation is a bit silly. I mean, it was very briefly the fourth largest stock in the world, overtaken Microsoft at some point. So, I mean, obviously the valuations do seem quite obscene. I think maybe one thing to add is maybe how that affects what we do. You know, we invest in different indices. Well, this shouldn't cause too much of an impact onto indices, just given the fact that, you know, SpaceX has a very small free float. So I believe it's actually only 1% in the NASDAQ actually came joined, I think it was yesterday or the day before. And, you know, with also, you know, maybe Anthropic and OpenAI also listing again, I believe that the likely free floats are quite small. So the impact within the indices should also not be too large either.
Good stuff. Hannah, next question, please.
Is the Sell America trade back on?
Oh, this is the topic of debate between Vijesh and I on a daily basis. And, you know, for all intents and purposes, you know, Vijesh has been the voice of reason. So I'll defer this question to you, Vijesh.
Yeah, obviously, I think it's very easy for us to maybe sometimes think that the US is too expensive, particularly maybe in the last couple of years where things have been a bit less stable than usual. Obviously, again, all the brief talk about the Fed independence and things like that. But at the end of the day, the US has the tech. It has a more robust economy, as we saw with the rate hike expectations that we saw earlier in the webinar. It's just it's a behemoth. And it's quite difficult, I think, to bet against. You know, so most of us live in the UK, some also in Europe, and I think we can all speak to maybe some of the headwinds that we face over here. And a lot of these headwinds, the US doesn't really have. So I think long term, I don't think that there's necessarily a Sell America trade, but of course there will be wobbles, particularly when we get some extreme events that we've seen in the last few months.
Yeah, and this is also where sentiment meets reality, right? You know, you know, when I spoke to clients about this, you know, I was with them. You know, I also thought the U.S. empire is taking a hit from U.S. politics right now, not just because of the politics, but also, you know, the rest of the world is you know, they're going to do their own thing if you have an unreliable partner in the U.S. So long term, you know, the big beneficiary out of all these actions that the Trump administration is going through is China. But you know, if you look at investing in China, you know, they have other issues. They have this huge real estate bubble. They obviously have a large interference in politics in the markets. You remember when she you know, hammered the Chinese tech market to get them under control. These things are still trading very, very cheap. So the thing is, yes, I'd like to sell America, but where do you go? You can obviously go into Korea or Taiwan, but you know, that's up 200%, and the growth just isn't there in Europe, and you have other problems in China, and that's why, you know, you got to weigh that against sentiment a little bit. And as we saw, the earnings growth is still in the US. So I personally, you know, maybe on a 10-20 year view, you know, the US trade is gonna disappear a little bit, but you know, in the short to medium term, it's difficult to see. Next question, Hannah.
What is going on in Japan?
There was a song in the 80s by Alphaville called Big in Japan. So, you know, I'm old. So, you know, I started trading, you know, after the Japan bubble burst in the mid 90s. And every year, the Wall Street pundits came out and said, you got to buy Japan. You know, this is the year of Japan. We're going to get back to levels in the 1980s. And every year it just flopped. And I watched this for decades. It just never got anywhere. And now in these last 2 years, Japan has just been on a tear and has obviously taken out these highs that it made in 1987. I don't get it. There's obviously the yen as well. You got to look at the yen. The yen is at the weakest level in, I think, 20 years as well. So there's a weakening yen. So that means as Japan goes up, but the currency goes down, you know, it's not really real. But having said that, the growth still far exceeds the weakness in the yen. Clearly, they have a tech element, right, Vijesh? Japan has some tech stocks.
Yes, they do. Again, a bit of semiconductor exposure.
They have a bit of semiconductor exposure. So there you go. But it already started going up before, you know, the meme trader got a hold of this, right? So, you know, I think they also had a change in leadership. You know, then you have the carry trade as well with the yen. You have this aging population. So in other words, there's so much going on in Japan. I've just lost track. I don't get it, but obviously, if you own it, it's nice that it's gone up. Any pearls of wisdom, Vijesh, since I clearly don't have them?
And I think you mentioned basically everything that's going on in Japan. I guess maybe the one other thing would be obviously, as you mentioned, it has an aging population. Inflation has been relatively subdued, but after 2022, that trend has sort of reversed. They're one of the very few, or at least were one of the very few regions hiking rates. So also maybe there's a bit of belief that that's finally behind them, the sort of 30, 40-year winter that they've had. And maybe they can now go on to better things, particularly with the stimulus brought about by the change in leadership.
Long-term yields are worrying me a bit, right? So long-term yields in Japan just crossed that 4% level. Remember, they have a lot of debt. So I think that debt to GDP ratio is still around 250%. So as they have to rebalance their debt, obviously they can't do it on long end, not with $20 trillion of outstanding debt. So the short-term rates are still quite low. I think they're 1.25 short-term rates, which, as Vijay said, have recently gone up. They used to be negative. But yeah, I see nothing but tailwinds really, but it goes up, which is what makes this game so beautiful. It's just, random. Vijay, on that note, Hannah, any more questions? Since I seem to be running out of pearls of wisdoms, unfortunately.
Yeah, we've got one last question.
One more. Okay.
Yes. How will the US midterms affect the markets?
So this is the reason I had that chart in there. So yeah, obviously it will depend upon what happens. So the idea is that if the Dems take either the House or the Senate, then it just leads to a bit of paralysis in these actions. It'll just slow down these moves one way or another, right? I mean, say what you want about Trump, but he does seem to change his mind a lot. So if we can stop that craziness, I think it'll be very good for the markets. Having said that, it's tough to imagine that it's going to stop the Trump administration completely. So in that regard, it might just be a non-event, the midterms, either way. You could then have, if the Dems take both chambers, then there'll be a lot of impeachment, there'll be a lot of lawsuits. Then things might come to a crawl, which might be a good thing because then business can just get on with things. On the other hand, it might then also lead to very irrational decision making. As Trump is under attack, he might then lash out, which would mean deploying the military or starting another war. Who knows? It's definitely going to be interesting what happens, which is why I said as of September, I think it's all we're going to talk about is the US midterms. Vijesh, how do you see things progressing there?
Yeah, I mean, not much to add, to be honest. Yeah, it could be non-event. We could see a bit of volatility, at least going into it as well. Again, it really does, depend on a few factors, and particularly maybe with the news this morning, that might also affect things as well going into that.
That's the thing. There's still a lot of road, right? We've got these wars going on. We've got petrol prices. We've got bills that are going through the chambers right now. So like I said, policy will now be driven by the midterms, but you might then get a non-event. Let's see. But it's certainly all we're going to talk about in the months to come. I think that's it, Hannah, right?
Yes. Okay,
awesome. If you have any more questions, please feel free to email us. And like I said, we love to stay in touch. So if there's anything on your mind, don't hesitate to reach out. I wish you a great summer. I wish us all some great World Cup games. Go England. And we look forward to seeing you on our next webinar in October. Wishing you all the very best, and thank you very much for your attention. All the best. Bye-bye.